The stock market can be a pretty brutal place. One day it's cheering for a stock, and the next day it can punish it for no clear reason. And as an investor, it can sometimes give you a real shock, especially when you see your stock price going down even though the business is doing everything right. Now, being an investor in on holding myself, of course, I don't like to see the stock price falling. Nobody does. But here is the truth. I am not here for 1 day or 2 days or even 5 months. I am investing for the long run. And when you invest with a long term mindset, you don't get distracted by short term price swings. What matters is whether the business itself is performing, whether revenue is growing, margins are improving, and the company is expanding in the right markets. And that's where my faith lies in on holding. I believe in the fundamentals. I believe in the brand. And I believe that over time, strong business performance always pays off in the stock price. So, with that in mind, let's go through on holdings together. I will not only explain their Q2 2025 results, but also give you the bigger picture, how business is performing overall, where management is focusing for growth, and what the outlook looks like for long term. Welcome to Peaceful Investor. My name is Ricky, and this channel is about simplifying investing and building financial freedom. If you haven't subscribed yet, make sure you hit that button so you don't miss future updates. Remember, this content is only for educational purposes only and is not a financial advice. Always do your own research or consult a licensed financial advisor before making any investment decision. Before we dive deeper, let me quickly explain what holding is for those who may not be familiar. On is a Swiss sportswear company best known for its premium running shoes with the unique cloud tech cushioning technology. The brand started in Zurich in 2010 and has grown into a global player. Now selling in more than 60 countries, they make money mainly in two ways: through wholesale partnerships with sporting goods retailers and through their own direct to consumer channels like online sales and on branded retail stores. Wholesale is still the larger part of the business, but direct to consumer is growing faster and also gives them higher profit margins. While shoes make up the majority of their sales, On is also expanding in apparel and accessories, and even performance categories like tennis and trail running. Their strategy is to position themselves at the intersection of performance and lifestyle, a premium brand that appeals both to the serious athletes and fashion conscious consumers. So, in short, On makes money by designing and selling innovative high margin footwears and sportswears and is rapidly expanding its global presence. Let's take a look at On Holding stock price. The stock had a strong rally through 2023 and into early 2024, even touching the high 60s at one point. But since then, it's been a roller coaster, with sharp drops around earnings season, rebounds in the first half of 2025, and then another steady decline over the past few months. Today, the stock trades around $43, which is well below last year's high. So, that's the story of the share price. Now, let's look at the fundamentals, how the business has actually performed during the same period. Starting with revenue, back in 2019, the company had just $269 million in revenue. In 2020, that grew to 453 million, then almost doubled again to 793 million in 2021. In 2022, revenue crossed 1.28 billion and by 2023 it was nearly 2 billion. In 2024, sales hit 2.63 billion a 32% increase from the year before. And over the trailing 12 months, revenue has reached $3.14 billion. That's a consistent double digit growth story year after year. Now, looking at the gross profit, the trend has been very strong, climbing from around $140 million in 2019 to almost $1.9 billion today, showing both sales growth and margin improve. When it comes to operating profit and net income, On Holding turned the corner in 2022 after years of losses. In 2024, net income peaked at $275 million, but on a trading basis, it has dropped back to around 151 million. This pullback isn't because the business has stopped growing. It's mainly due to currency headwinds and the fact that company is still in a heavy growth phase. On is pushing hard into direct to consumer sales, retail store expansion, and new product categories like apparel and performance sports. And all of these require big upfront investment before they pay off. The same story shows up in cash flows. Operating cash flow reached at record 562 million in 2024, but in the trailing 12 months it has come down to about 466 million. Free cash flow also dipped from nearly 494 million in 2024 to around 390 million. Again, this isn't a sign of weakness in demand, it reflects higher spending on inventory, marketing, and new store openings, which all tie up cash in the short run. So, the bigger picture is this: ON's fundamentals remain very strong with consistent revenue growth and healthy gross profit. But as a business still in its growth phase, profitability and cash flow can dip temporarily because money is being reinvested back into expansion. For long term investors, that's often exactly what you want to see because those investments today are what fuel bigger profits in the future. Now, I'm going to explain On Holdings Q2 2025 earnings, which I studied firsthand from their official website. And remember, this is a Swiss company, so all the numbers are reported in Swiss francs. For the quarter, revenue came in at 749 million francs, which is strong 32% increase year on year. And on a constant currency basis, the growth was even higher at 38%. The gross profit reached 460 million francs, which is a gross margin of 61.5%, an improvement compared to 59.9% in the same quarter last year. As an investor, this is always you wanna see the margins to go up. Operating profit more than doubled, coming in 92.8 million compared to 47.3 million last year. However, when we look at net income, the company posted a loss of 40.9 million compared to a profit of 30.8 million francs in the prior year. This swing into the loss was mainly driven by large foreign exchange impacts. On a adjusted basis, EBITDA stood at 136.1 million, representing a healthy margin of 18.2%, up from 16% last year. On Holdings earns its revenue across different channels. In Q2 2025, direct to consumer sales reached at 308.3 million francs, which is an impressive 47.2% growth year on year. And on constant currency basis, the growth was even stronger at 54.3%. On the wholesale side, the sales came in 441 million, up 23.1% year on year or 28% on constant currency basis. What really stands out here is that direct to consumer made up 41.1% of total sales, which is the highest share ever for a second quarter. Now, why is direct to consumer growth so important? It's because sales through on stores and online platform typically carry much higher margins compared to wholesale, where the company has to share profit with the retail partners. Direct to consumer also allow on to have a closer relationship with customers, stronger brand control and more pricing power. So every increase in DTC sales not only boosts revenue but also helps improve profitability and long-term brand strength. Let's look at the cash flow side of the business for the first half of 2025. Operating cash flow came in at 89.1 million, which is down from 183 million in the same period last year. The main reason for this decline is that a lot of cash is tied up in higher receivables and inventory as the company continues to scale its wholesale and direct to consumer operations. Free cash flow, which is the cash left after capital expenditures, was 59.6 million compared to 157 million in the prior year. As an investor, ideally, I want to see free cash flow increasing year over year, not decreasing. But at this stage, I can understand why this is happening. On holding is still in a growth phase, and they are deliberately using a lot of cash to expand into new markets, build inventory, and open new stores. In the short term, that feels like a pain point because it reduces free cash flow, but in a long run, it actually a positive because these investments are laying the foundation for stronger revenue and profitability in the future. The company also recorded 25 million in stock-based compensation, which is around 1.7% of revenue. Now, as a shareholder, this is something I don't really want to see because it dilutes my ownership, meaning my percentage stake in the company gets a little smaller. But again, I can accept it at this stage because ON is still in heavy expansion mode. They need to attract and retain top talent, and rewarding employees with shares in the common way to do that while keeping more cash available for growth. Over time, I want to see stock based compensation come down as a percentage of revenue so that dilution risk becomes smaller. On holding ended Q2 with 846 in cash and cash equivalents and a current ratio of about 2.5 times. And the company has very little financial debt, with the main obligations being around 498 million in the lease liabilities tied to its retail expansion. Looking ahead, ON's management is staying focused on growth. They are pushing hard into direct to consumer sales, opening more of their own retail stores and strengthening e commerce. They are also investing in the apparel category, which is growing much faster than footwear and expanding their premium retail footprint worldwide. Asia Pacific remain a key growth driver with sales more than doubling this quarter, and the company continues to build its brand at the intersection of lifestyle and performance. Because of this momentum, management has raised their full year 2025 guidance. They now expect net sales of at least 2.91 billion francs, representing growth of more than 31% in consistent currency. Gross margin is guided between 60.5 and 61%, slightly higher than before, and adjusted EBITDA margin is expected in the range of 17 to 17.5%. For us as investors, a guidance raise is a positive catalyst. It shows that management has stronger confidence in the business than before, that demand is running ahead of expectations, and that profitability should hold up even as the company invests heavily in growth. In simple terms, raised guidance reduces uncertainty and gives long term investors more conviction in the story. Now let's look at the valuations. As of today, On Holding is trading at $43.84, which gives a market cap of about $14.3 billion. Dollars. On a trading basis, the stock trades at price to sale ratio of 4.15 times with a forward price to earn ratio of 29 times, a trailing PE of 86 times, and a free cash flow yield of 3.08%. To quickly summarize what we have seen so far, On Holding continues to deliver over 30% revenue growth year on year. Gross margins are expanding above 61%, and while net income and free cash flow dipped on a trailing basis, this is largely because of company is still in its growth phase, reinvesting heavily into direct to consumer, new markets, and April expansion. Management even raised their guidance for 2025, which shows strong confidence in the business momentum. At this price, I feel On Holding is actually trading at an undervalued level. This is still a company growing at more than 30% annually, and yet it's only valued at around 4 times sales, which is very cheap for a premium global growth brand. Now, I want to be transparent. I am an own investor myself. I bought my shares when the stock was around $46, and right now I already have enough exposure in my portfolio, so I don't plan to add any more. But yes, I think today price represents a good entry point for long-term investors. That said, just because I own the stock doesn't mean you should go and buy it. Always do your own due diligence, study the business carefully, and make sure it fits your investment strategy before making any decisions. And before I wrap up, I want to share why I created this channel. I started Peaceful Investor because I truly want to help change the lives of my viewers by giving real value, simplifying investing, and showing that financial freedom is possible. If you find value in those videos, make sure to subscribe. Your subscription motivates me to keep going, helps me grow, and allows me to continue creating content that delivers real impact for you. Thank you.